Hello, hello. Hopefully no introduction is necessary, as all of you know me because this is a client-only presentation, but Scott Lanigan here. Again, I hope you know me. If we don't, then I think we may have some larger issues. You'll probably see my director of positive vibes in the background. You can probably hear him clicking around his nails, but Buddy's here as well. I know a lot of you have met him, but yeah, so just don't get distracted by the little tail that you'll see wagging up and down. Anyways, as I mentioned, this is a client-only presentation where we'll talk broadly about your portfolio's investments, portfolio positioning, and how I'm positioning portfolios going into Q2 and the rest of the year. So please keep in mind that I'm talking to only clients in this presentation, and all of y'all have varying portfolio objectives, risk tolerance, time horizon, tax rates, etc. So although I'm talking with a more focused client consideration in mind, not everything in this presentation will apply to you, watcher of the video. If you have any questions over your individual circumstance, portfolio, or investment performance, please reach out to me directly. So I'll try to keep this presentation brief, as I don't want to rehash many of the same talking points I discussed in the quarterly market commentary video. So if my commentary over certain subjects seems short or inadequate, it's probably because I discussed it in more detail in the other video. And finally, the fun disclosure language, which I'll throw up here. Feel free to pause and read if you really want to, but the main things to keep in mind are past performance isn't indicative of future performance. Some of the investment performance here is going to be simulated, and probably more importantly, your investment and portfolio performance will differ than what I discussed here today. This is primarily because I've invested each of you at varying times over the quarter and in the previous years, and I typically customize portfolios more than just sticking you in a model portfolio. So you can view your portfolio performance when I publish the returns later this week, and I'll send you an email when I publish those reports so you can take a look at them. Alrighty, so with all of that in mind, let's get to discussing underlying investment performance, starting with equities. As we can see, equity markets rallied to varying degrees in Q1 2024. Large cap growth stocks were the best performing equity class, and emerging markets performed the worst. Large cap growth outperformance was largely attributable to the sizzle and steak over the AI industry, better than expected earnings in the communication sector. Emerging markets, while still eking out a 1.72% return, were hampered by the negative commodity performance, particularly that of iron ore, and concerns over China's growing debt in its real estate and shadow banking sectors. Now moving over to fixed income. Fixed income performance varied widely depending on the length of maturity and credit quality of your bond portfolio. In Q1, interest rates rose across the yield curve and credit spreads fell. So longer maturity, high quality securities perform poorly, as these securities are more sensitive to interest rates, whereas shorter maturity, low quality securities perform better as they're more sensitive to credit spreads. Now let's dig deeper into active positions I'm taking within each of your portfolios. As many of you know, my investment philosophy favors growth stocks over value stocks. This is because earnings growth is the largest contributing factor to long-term stock performance, and growth stocks grow earnings the fastest. So digging into active positions, we can see that growth broadly outperformed the blended indices as the emerging AI industry, better than expected economic growth, and the prospect of 3 interest rate cuts in 2024 propelled growth stocks higher, generally speaking. We can see that the small cap growth index significantly outperformed due to small AI-focused company earnings surprises, as in the case of Super Microcomputer and Vertiv Holdings Company. But this small growth outperformance was realized to varying degrees in each of your portfolios because I unwound this active position throughout Q1. Thinking through it more, I concluded that a blended approach to small cap equities is more prudent versus growth. There are 2 reasons why. One, there are reams and reams of return data that suggest small cap value outperforms over long time horizons. And 2, the best growth companies typically IPO when they're a mid cap or large cap company and not when they're small. The former is because many small cap companies don't have significant institutional coverage, lending itself to market efficiencies and future outperformance. And the latter is because high-performing small-cap companies would rather raise capital through venture capital instead of public markets. Now, speaking to the ex-China emerging market allocation, China is facing significant debt issues, so it's unsurprising that the emerging markets ex-China index outperformed the normal emerging markets index. To illustrate, China declined about 2.5%, while the Vanguard FTSE Emerging Markets ETF returned 1.72%. So an allocation away from an underperforming country like China leads to outperformance. So now that we've discussed investment performance and active positioning, let's look at policy portfolio performance. All EID Capital policy portfolios had positive performance in Q1. Now, the degree of outperformance was due to the concentration of equity exposure and growth equity exposure in particular. Fixed income-wise, the length of maturities and credit quality explains the relative performance of your bond portfolio. Again, your performance likely didn't match your policy portfolio because of timing and further customization of your investment portfolio, which is a nice segue into discussing my high-yield fixed income thesis. So I've discussed this with many of you one-on-one, and if you've read my high-yield paper, you already know this, but I think high yield is currently priced to return roughly the same as large-cap U.S. equities over the next decade. This is mostly due to the high valuation of the top U.S. companies, most of which are tied to the excitement over artificial intelligence. Also mentioned in my paper, high yield performs the best when there is market turbulence due to excessive equity valuation. Now, I want to be very, very clear. I don't believe that we are near the valuation levels of the late 90s, early 2000s. But valuations are rich, making further price appreciation very sensitive to earnings expectations. If these companies start to disappoint, it will likely cause equity markets to fall and provide an opportunity to pick up equities at a better price point and long-term expected return. So given the expected return parity between high yield and large cap US stocks, but differing risk profiles, high yield performs better when equity markets fall, I've made different tactical allocations to varying degrees in many of your portfolios, the degree of which depends on your investment goals and tax situation. Tactical positioning is short-term in nature, and as such, I intend on allocating many of you back to equities to get back to your long-term policy portfolio. But it will depend on the expected returns between each asset class, and unwinding the high-yield position will likely occur when there's an equity market correction. So to wrap up, I want to thank all of you for being an EID Capital client, and I love working with you all. This is very easy to say since you're either a long-term friend or family member, or someone I didn't know previously who now I consider a friend. EID Capital wouldn't be where it is today without you, and it's really hard to express how appreciative I am for you entrusting me with your finances and investments. Thanks for watching, and of course, and as always, if you have any questions over your individual financial circumstance or investment portfolio, please don't hesitate to reach out. Later, y'all.